Your 2026 Medicare premium may not be based on your 2026 income. It may be based on your 2024 tax return. And that is the part many retirees miss. You open a Medicare notice. The monthly premium is higher than you expected. You look at your income now and think, wait, I am not making that kind of money anymore. Maybe you're retired. Maybe you stopped working. Maybe your spouse is no longer here. Maybe 2024 was just an unusual year. One larger IRA withdrawal, one Roth conversion, one investment sale, 1 year where your income looked higher on paper than it feels in real life. But Medicare may not be looking at how your life feels today. It may be looking backward. For many retirees, the 2026 Medicare Part B and Part D income-related charges are generally tied to tax return information from 2024. That means a decision you made 2 years earlier can show up later as a higher Medicare bill. And if you do not recognize why it happened, you may quietly pay the higher amount month after month. Most retirees do not connect the two. They see the Medicare notice in 2026, but they do not think about the 2024 tax return sitting in an old folder. So they assume the bill is random, or they assume Medicare made a mistake, or they just pay it because they think there's nothing to check. But before you do that, you need to understand two words, MAGI and IRMAA. MAGI means Modified Adjusted Gross Income. IRMAA means Income-Related Monthly Adjustment Amount. You do not need to memorize the full names, you just need to know what they do. MAGI is the income number Medicare watches. IRMAA is the extra charge that can raise what you pay for Medicare Part B, and it can add an extra charge to Part D. If you want Medicare, Social Security, and retirement tax rules explained without panic, without pressure, and without confusing jargon, subscribe to Senior's Heaven. These are the quiet rules retirees usually learn after the bill arrives. That is why this matters. Medicare may not be asking what your income feels like today. It may be asking what your tax return said 2 years ago. And that old number may be the reason your premium went up. Here is where the mistake begins. Many retirees hear the word income and think only about money coming in every month. A Social Security check, a pension deposit, maybe a small amount from part-time work. But MAGI is not your monthly spending money. It is not your bank balance. It is not what you have left after bills. For Medicare income-related charges, the calculation begins with adjusted gross income on Form 1040. Then tax-exempt interest is added back. That combination becomes the MAGI number used for Medicare income-related charges. And that is where retirees get caught. Because your taxable income and your Medicare income number are not always the same thing. Your standard deduction may lower what is taxable, but it does not make the income disappear from the Medicare calculation. That is a very important difference. A retiree may look at the final tax bill and think, I did not owe that much, so I should be fine. But Medicare is not starting with how much tax you owed. It is looking at the income number behind the return. And Medicare does not look at your income and say, close enough. It uses brackets. Once your MAGI crosses a bracket, even slightly, the amount you pay can change. For 2026, the standard Medicare Part B premium is $202.90 per month. But if your MAGI is above the income threshold, the premium can be higher. For an individual filer, the first 2026 IRMAA line starts above $109,000. For a married couple filing jointly, it starts above $218,000. Those numbers may sound high at first. But remember what matters here. Medicare is reading the tax return, not the monthly budget. This is the income number on the tax return after different pieces are added together. At the first IRMAA level in 2026, the Part B premium becomes $284.10 per month. That is $81.20 more than the standard Part B premium. And Part D can have an extra $14.50 per month added on top of the drug plan premium. If this is the first time you're hearing that one old tax return can raise a future Medicare bill, tap like so, more retirees know to check the number before they quietly pay more. That may not sound devastating for 1 month, but retirees do not pay Medicare for 1 month. They pay it month after month. So a premium increase can quietly follow the household budget all year. And if both spouses are on Medicare and the joint return crosses an IRMAA line, both people may feel the higher monthly cost. That is the threshold trap. The problem is not always one big dramatic mistake. The problem is the line. And once the tax return crosses that line, Medicare may treat that year differently. Now let's talk about the retirement decisions that can push people over the line. Not because they are bad decisions, not because the retiree was careless, but because the tax return sees them differently than the household does. Medicare does not ask why the income happened. It asks what the tax return reported. The first group is retirement account withdrawals, a traditional IRA withdrawal, a taxable 401k withdrawal, required minimum distributions, money taken for bills, money taken for repairs, money taken to help family. Emotionally, that may feel like using your own savings, and it is. But on the tax return, if the withdrawal is taxable, it can increase adjusted gross income. And once adjusted gross income rises, MAGI can rise with it. The second move is a Roth conversion. This one catches careful retirees, because many people do Roth conversions for smart reasons. They want to reduce future required withdrawals, they want more tax-free money later, they want to leave a cleaner account for a spouse or children. The strategy may make sense, but if pre-tax traditional retirement money is converted to Roth, the conversion can create taxable income in that year. That income can raise MAGI. And if the conversion happened in 2024, the Medicare effect may not show up until 2026. So the question is not, was this move smart? Sometimes it was. The question is, did anyone check the Medicare side before doing it? The third move is selling investments, stocks, mutual funds, exchange-traded funds, other taxable investments. If the sale creates capital gains, those gains can show up on the tax return. And this can surprise retirees because they do not always feel richer after selling. Maybe they sold to create cash. Maybe they sold because they were nervous about the market. Maybe they sold to simplify accounts. But the tax return does not ask whether the money was spent. It only records the taxable result. The fourth move is selling a home. Not every home sale creates taxable income. Many homeowners may qualify to exclude part or all of the gain from selling a main home. But if there is taxable gain left after the rules are applied, that gain can affect the return. And for retirees who have lived in the same house for decades, this can matter. The house may not feel like an investment. It may feel like the family home. But if the sale creates taxable income, Medicare may still see the result later. The fifth group is quiet income, bank interest, dividends, tax-exempt interest, the taxable part of Social Security. Each one may look harmless by itself. A little interest here, a dividend there, a certificate of deposit, a money market account, a treasury bill. But at the end of the year, the total is reported. And tax-exempt interest can surprise people the most because the words tax-exempt sound like the money should be invisible. But for Medicare income-related charges, tax-exempt interest can still matter. That is why retirees should not look at each item alone. The real danger is the stack. One withdrawal, one investment sale, 1 year of higher interest, one Roth conversion, one taxable part of Social Security, one home sale with taxable gain. Each piece may look manageable, but together they can turn a normal retirement year into a high MAGI year. And that high MAGI year can come back later as a Medicare premium surprise, because a decision can be good for taxes and still create a Medicare premium surprise later. This is the part that frustrates retirees the most. The income may be gone, but the Medicare premium can still show up later. You may be looking at your life in 2026, but Social Security may be looking at your tax return from 2024. Those are two very different pictures. In 2024, maybe you were still working. In 2026, maybe you are fully retired. In 2024, maybe you sold investments. In 2026, that money may already be spent. In 2024, maybe you did a Roth conversion or took a large withdrawal. In 2026, your monthly income may be much lower. That is why many retirees look at the Medicare notice and think, this does not match my life anymore. And they may be right. It may not match today's life. It may match an older tax return. Emotionally, that can feel like being charged for a life you're no longer living. But this is where you have to be careful. A higher Medicare premium does not always mean you are stuck with it forever, but it also does not mean everyone can get it lowered. Both things are true. Some retirees may be able to ask Social Security for a new decision, but only if the facts fit the rules. This is not about calling Medicare and saying, I do not like this bill. It is not about saying, my budget feels tight. It is not about arguing that the rule is unfair. Social Security is looking for a reason that fits their process. One major reason is a life-changing event. That means something happened after the tax return year that significantly reduced your income. For example, marriage, divorce or annulment, death of a spouse, work stoppage, work reduction, loss of income-producing property, loss or reduction of pension income, or certain employer settlement payments connected to closure, bankruptcy, or reorganization. Those are not just emotional events. For Medicare IRMAA, they can be official events that may allow Social Security to look at a more recent income year. That word may is important. A life change by itself is not always enough. The event must reduce the income number Social Security is using. So if your 2026 Medicare premium is based on your 2024 tax return, and your income dropped after that because of one of these events, you may be able to request a lower income-related adjustment. The form connected to this is called SSA 44, Medicare Income-Related Monthly Adjustment Amount Life-Changing Event. You do not need to memorize the name, but you do need to know that the form exists, because many retirees simply pay the higher premium without realizing there may be a review process, and if your tax return was amended, or if the IRS information used was later corrected, That may also matter, but do not guess. Do not assume. Check the notice, check the tax year, check the income number, then contact Social Security and ask what process applies to your situation. Not Medicare, Social Security. Because Social Security handles the IRMAA decision, and if you ask for a review, be ready with documents, not feelings. Documents. Your Medicare premium notice, the tax return year they used, proof of the life-changing event if one applies, a more recent tax return or income estimate if requested, any amended return proof, any corrected tax forms, and any evidence that shows your income was reduced. You're not asking for special treatment. You're asking Social Security to review whether the income number still fits the rule. And for some retirees, that can matter. The best time to think about IRMAA is not when the notice arrives. By then, the tax return may already be filed. The income may already be reported, and the Medicare premium may already be based on that older number. The smarter time to think about IRMAA is before the big retirement move happens, before the Roth conversion, before the large IRA or 401k withdrawal, before selling investments, before selling a home with a possible taxable gain, before assuming one unusual income year will not matter. This does not mean retirees should be afraid to touch their money. That is not the message. The message is that every large retirement move should be checked from more than one angle. Most people ask one question: how much tax will I owe? That is important, but it is not enough. A retiree also needs to ask, what will this do to my MAGI? Could this push me into an IRMAA bracket? Could this affect my Medicare premium 2 years from now? And if I am married, could it affect both of us? That last question matters, because the decision and the Medicare bill do not always arrive in the same year. A tax move in 2024 may affect Medicare in 2026. A tax move in 2025 may affect Medicare in 2027. A tax move in 2026 may affect Medicare in 2028. That delay is what makes the surprise feel random. But it is not random if you know what to check. So before a major retirement transaction, estimate your MAGI for the year. Not perfectly, but carefully enough to know whether you are near a line. Estimate the full income picture for the year: withdrawals, conversions, capital gains, interest, dividends, tax-exempt interest, and how those pieces may affect the taxable part of Social Security. Then compare the total against the current IRMAA brackets. And remember that future brackets may change before the Medicare premium year arrives. This is also why retirees should be careful with advice that sounds good in only one category. Someone may say, convert more to Roth, sell the investment, take the withdrawal, lock in the interest, use the account now. And sometimes that advice may be right. But if nobody checks the Medicare side, the advice is incomplete. A good retirement decision should not only ask about this year's tax bill. It should also ask about Medicare premiums, Social Security taxation, cash flow. And the next 2 years. That does not mean you need to become a tax expert. It means you should bring the right question to the person helping you. Ask your tax professional or financial advisor directly. Will this increase my MAGI? Could this trigger IRMAA? Could this raise my Medicare Part B premium or add a Part D charge later? Is there a way to time this move better? Would spreading the move over more than 1 year reduce the risk? And if I am already close to a bracket, how much room do I really have? Ask them to show you the estimated MAGI number, not just the estimated tax bill. Because the danger is often not the move itself. The danger is making the move without knowing how close you already are to the line. The same withdrawal can affect 2 households differently. The same Roth conversion can be harmless for one person and expensive for another. The same capital gain can be manageable in 1 year and painful in another. That is why generic advice can be dangerous. Your Medicare premium is not based on someone else's retirement plan. It is based on your tax return, your filing status, your income mix, your timing, and your MAGI. The goal is to know the story before Medicare reads it. When the Medicare notice arrives, do not panic, but do not ignore it either. This is not the time to guess. This is the time to check. Because a Medicare premium notice is not just a bill, it is a clue. It points to a tax year. It points to an income number. It points to a filing status. And sometimes it points to a mistake the retiree never noticed. So before you quietly pay the higher amount, check the chain behind the notice. First, check the tax year. For 2026 premiums, Social Security generally looks at tax information from 2024, but sometimes older tax information may be used if newer IRS data was not available. So do not only look at the dollar amount, look at the tax year. Second, check the filing status. Were you single, married filing jointly, married filing separately? Did your household change after that tax return? Filing status matters because IRMAA brackets are not the same for everyone. Do not compare your Medicare bill to your neighbor's bill. Their tax return is not your tax return. Third, check the MAGI number. Pull the tax return they used. Look at adjusted gross income. Look at tax-exempt interest. Then ask what created that number. Was it a retirement withdrawal, a Roth conversion, capital gains, interest or dividends, tax-exempt interest, a home sale with taxable gain, or other income that made more of your Social Security taxable? Fourth, check whether the income was corrected later. Maybe you filed an amended return, maybe a brokerage form was corrected, maybe IRS information changed, maybe the number Social Security used does not match the final tax information. If that happened, do not assume the system already fixed it. Check, ask, document it. Because corrected tax information may matter, but you need proof, not memory, not a rough estimate. Proof. Fifth, check whether your life changed after that tax return. This is different from simply wishing the bill were lower. Social Security has specific life-changing event rules. If one of those events happened after the tax return year and your income went down, you may be able to ask Social Security to review the IRMAA amount. But again, the word is may. Not every change qualifies, not every income drop counts, and not every higher premium can be removed. That is why the notice matters. Read it carefully. It may explain the tax year used. It may explain the income information. It may explain your review or appeal rights. And it may tell you what steps to take. Do not throw it in a drawer. Do not just look at the first number and stop. And do not assume Medicare is the office that handles the income decision. For IRMAA, Social Security handles the determination. So if something looks wrong, or if your situation changed, contact Social Security and ask what process applies. Use this order. Tax year. Filing status, MAGI. Unusual income, corrected tax information. Life-changing event, documents, and the right office. Social Security. That is the checklist. Simple, but important. Because your Medicare premium is not just a number on a notice, it is the result of a chain, a tax return, a MAGI number, a filing status, an IRMAA bracket, a Medicare notice. That is the path. And once you understand the path, the surprise becomes easier to check. This video is not personal tax, legal, or financial advice. Your situation may be different. Your filing status may be different. Your income mix may be different. So before making a major retirement decision, speak with a qualified professional who can look at your actual numbers. But do not ignore this issue. Because your 2026 Medicare premium may not be based on your 2026 life. It may be based on a tax return you already filed. And the most expensive mistake is assuming that old tax return no longer matters. Sometimes it matters later, sometimes it matters quietly, and sometimes it shows up month after month in a Medicare bill you never expected. So before you file the next return, before you make the next big withdrawal, and before you assume the notice is random, check the year, check the MAGI, check the bracket, check the life changes, and check with Social Security if the number does not match your situation. That is how retirees protect themselves. Not by panicking, not by guessing, but by knowing which number Medicare is really reading.